Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is the top 3 mindsets of a good investor. My name is Shen Chu. I'm the moderator for this webinar. Now, before we begin, as usual, disclaimer, whatever is shared in this webinar is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mention here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Now, allow me to introduce our speaker for today. He graduated with a bachelor degree in finance from Coventry University, United Kingdom. He is a licensed financial planner and a financial advisor representative from Bank Negara. He's the co-founder of EECameron, whereby they share contents to more than 1 million views. He has more than 9 years of investment experience and trained more than 1,200 working adults to master the wealth growth strategy in 3 years. And he's also the founder of this strategy, Wealth Growth Strategy. He's none other than Mr. George Paul. So welcome, George, to this webinar. How are you, George?
Hi, Shen. Good evening. Everyone. Good evening. Yes.
All right, cool. So let me just hand over the session to you and stop sharing my screen. You may take over.
Okay, thank you, Shen. Okay, all right. Can everyone see my screen with the slides?
Perfect.
Great. Thank you, Shen, and good evening, everyone. So let me just do a simple jump straight into our learning outcomes today. All right. So I will just skip my introductions. Thank you, Shen, for introducing me today. Right. So coming today, just now we have mentioned today we are here to learn to know about the top 3 mindset of a good investor. So what are you gonna learn today, right? So basically, I will share with you the top 3 mindsets and the habits that most of the successful investors have. All right, you must be eagerly wanted to know what are the mindset that they have, that might potentially that we can learn from them and become a successful investor ourselves. Right now, secondly, I also identified the short-term trading mindset and the long-term investing mindset. I do the comparison between these two. Because of what? Because today we are going to learn about the investment mindset. And when we come to investment, often people will make a mistake thinking that short-term trading is also an investment. But indeed, it is, because investment is a broad idea or the concept of what we are doing in the market, right? But for short-term trading and for long-term investing, they actually have different habits and mindsets required for you to master these 2 skills, right? So I will do the comparison. And last but not least, I will share with you how to discover your money personality and the investing methods that suits you the best or not the better. All right. So with that being said, are you ready to learn? To learn about how these successful investor think and how they behave, right, to make them so successful, right? Are you ready? If you're ready, type in okay, and we are smooth, all right, and we are okay to move on to our next things. All right, great.
Yes, ready.
Now, yes, everyone is ready, right? Okay, now before I dive into the mindset, I have a few people to share with you, just to ask you whether you know all these gentlemen or not. All right, so the first one we have, right, can you name this guy? Okay, can you name this guy? If let's say you know who he is, put in his name. All right, put in his name. I just want to know how many of you know about the person that I'm going to share with you. All right, bear with me, we will have 6 person. All right, okay, the first one is Warren Buffett. Great, everyone know about this guy, right? Now, who is this second one? Who is this second person? All right, I think this is getting quite tricky because not many people know about him. Okay, all right. Okay, many people still say Ray Dalio. No, you're wrong. Yes, I get the correct name. This is Peter Lynch. right? He's a former manager of Fidelity Magellan Fund. If you know, this fund is very famous in the States. All right. Now, who is this third person? Okay, who is this third person? And oh, great. Wow. Now, Benjamin Graham. Now, look at the reply. I can know that Benjamin Graham is famous than Peter Lynch in the eyes of our audience today, because you guys know about Benjamin Graham, and he is the father of value investing, and that's why you know. And he has a very famous book, right? All right, next. Now, this person, okay, this person, I know not many people heard of his name, but you, I think might have heard of his very well-known fund or the fund house before, right? No, he is not George Soros. Who else can guess his name, right? Okay, not Carl as well. Okay, now this gentleman here is Sir John Templeton. Yes, wow, congratulations to our audience that can guess it right. Yes, this is Sir John Templeton, the founder of the Templeton Growth Funds. Now, the fifth one, I don't ask anymore, because if you know Warren Buffett, you must know his partner as well. And he is Charlie Munger. And last but not least, wow. Now, I saw this gentleman's name appear just now. All right. So I won't let you make a guess. This gentleman here is Carl Icahn. Okay. He is also a very famous investor and also entrepreneur, right? Now, what all these people they have in common? Can anyone tell me what they have in common? All six guys, right? Now, is it they are old? Oh, money. Yes, yes, they are rich. Yes. Okay. They are old, maybe, because just now when I shared all six of them, I think they have a silver hair. They are old, all right? And they are all Westerner. Yes, like what our audience say today, right? They are all Westerner. And yes, just now you guys mentioned rich, right? They have a lot of money, human. Wow, very funny, yeah. But yes, they are all very successful investor. Can everyone agree with me? They are all very successful investor. If you think yes, you put in yes for me, right? If you think they are very successful investor, you put in a yes, right? Okay, then I can get everyone is agree with me at this moment, all right? Now, if let's say you think they are a successful investor, then moving on, I will review with you what all these successful investors think and what mindset that they have in common. Now, are you eager to know about it or not? Come, okay? Now, I won't waste your time. Let us just move on to review the top 3 mindset of all these successful investors, right? Now, the first mindset that they have, is they always think long term. Okay, they always think for the long term. Now, when we say about investing, it is always a lifelong journey. Okay, I want to ask you some questions, right? When you invest, what is the end goal in your mind? Do you want to invest for your entire life, or you want to invest just for a year or two? So that if let's say you profit enough, then you just stay away from investment. I bet not many people will do that, right? So everyone think that investing is actually a lifelong journey. You can do it if you master the skills. You can do it until you are old. Even until you retire, you still can do the investment. Am I right? So investing is actually a lifelong journey. And this is what all the successful investors think about it as well. Now, for this successful investor, for them, investing is also not a get-rich-quick scheme. That's why they know, in order for our investment portfolio to grow to a good or grow to a certain amount that we desire, right? It takes times. So times, it's a long term. And investment is not a get-rich-quick scheme. That means we have to keep investing, for quite a period of time. And from there, we will see the capital growth of our entire investment portfolio. Am I right? Now, when we talk about long term, if let's say I ask you to keep investing using the same formula, using the same strategy for 10 years, for 20 years, you might get bored and you will start to find some short-term tradings hobby, just to kill some boredom. Am I right? But for this successful investor, for them to think long-term, it requires our patience and also discipline, to know that our end goals and what are the strategies that we have to always stick with. Now, this required a lot of our patience. Okay, so these are the mindsets that they have, right? What else? When you say about think long term, right? They all focus on the fundamental of their investment. All right, you can name me some of the investment or the stocks or the companies that the investor that I mentioned just now that they invested in. All right, often they will hold it for quite a period of time, if not a decade, 2 decades, even more. All right, this is what they do. Okay, because they focus on the fundamental of the investment. And if I ask you, right, are you focusing on the fundamental of your investment? Are you doing so? Okay, if you're not doing so, let's just reflect ourselves. Are we doing a long-term investment, or we are just merely following the trend, in the market? This is very important, right? Now, if let's say you are thinking long-term, then you are willing to hold them for the long-term as well. Now, even in the face of short-term market volatility. Am I right? We know that market is always full of fluctuations. Every investor think differently. We have a different sentimental element inside, and it makes the stock market volatile, and the price fluctuates every day. Now, if let's say you are a person who think for a long term, and all this short-term volatility will not affect your decisions, because we are focusing on the fundamental of our selections. Right. Now, this is what Warren Buffett said. The stock market is actually designed to transfer the money, from the active to the patient. Now, it means that if let's say you are a patient person and you always think for a long term, then stock market is actually very suitable for you, because they are designed to transfer the money from those who are actively engaged in the market to you who think long term. Right. Now, these are the theory, and this is the mindset, the first mindset that all the successful investors have. Now, you might not want to know how all these investors illustrate or demonstrate this mindset in their strategy or in their investment journey, right? So let me just say review. The first that they do, right, is buy and hold strategy. Am I right? Okay, let me give you a good example, right? Warren Buffett, everyone know, he bought Coca-Cola shares, listed on New York Stock Exchange in 1988 and hold until today. Come on, guys. 1988 until today. I'm not even born at that time. Am I right? And he is buying and holding that shares until today. Why? Because he thinks for a long term, and he knows that the fundamental of this company never change. So he still hold it until today. And what are the good, what are the benefits of holding the good companies? He get an annualized annual return of 10%. See, this is a very good return. Annualized annual return of 10% plus dividend income every year. It sounds good to everyone, do you? Okay, if it sounds good, put in yes, I also want it, right? Put in yes, Coca-Cola, good, right? Now, but I don't drink Coca-Cola. Yeah. All right. Now, other than buy and hold strategy, what are the things that they always do? Oh, somebody say 10% is too little. Now, if let's say you are using a compounding interest, 10% is actually amazing, because not many people in the market can deliver 10% per annum annual return. Am I right? Am I right? Now, what else they do? Okay, what else they do when they practice this mindset of think for long term? They ignore short term noise. Now, like what I mentioned just now and what I shared about just now, right? Stock market, it always come with daily market fluctuations. So if let's say you are believe in your long term view on the stocks, you should not get swayed away by all these fluctuations, because it happens every day, right? when there are some news coming out in the market, it might have some different and contradictory sentiments involved, and it causes our stock price to go up and go down. But this is all the short-term noise. In the long run, if the fundamental of the company is good, then the company surely will grow. Now, let me show you the example. Look at Coca-Cola in the orange line. It outrun the performance of S&P 500 total return in a span time of, I think this is about 25 years to 30 years time. All right. By looking at this, you know that if we are an investor who ignore the short-term noise and we hold our selections for a period of time, this might be the outcome that you will get and the reward that you will receive from doing this, practicing this mindset. All right. Now let us move on to our second mindset that all these successful investors have. All right. Now the first one is they think long term. In order for them to think for a long term, they are also practicing value investing. Now, bear in mind, when we talk about investment, there are few investment strategy in a market, right? We have income investment, growth stock investment, but value is the fundamental of it, right? So what all these what they do, right? What they do, these successful investors, they will buy assets or such as stocks, or the companies when they are undervalued, and they are always committed to the principle of value investing. So what they do, they always stick up for companies with strong fundamentals, with a better competitive advantage compared to their peers, and also a margin of safety in their stock price. This is very important, yeah. When we talk about margin of safety, it always correlated with undervalue. Okay, and again, when we are practicing value investing, we will not get swayed away by the market hype or the price fluctuations in the short term. Now, why? Because we focus more on the underlying value of our investment. Am I right? Okay, I also wanted to quote this from Benjamin Graham. He said, the stock market is filled with individuals who know the price of everything, but the value of nothing. Now, from this statement, we can know that if you master the skill of finding the value of the underlying assets, you are already better than the average investor in the market. Now, this is actually a very good quote, right? Everyone can agree in it or not? Are you agree with what Benjamin Graham said, right? Because this stock market is always filled with all the people. They look at the price. Oh, this stock is only 20 cents. This is very cheap, right? And we look at the shares. Oh, this share is 10 ringgit. It's very expensive. But they don't actually know the value of these particular stocks or the companies. Am I right? Now, how this successful investor illustrate or demonstrate this mindset in their investment journey? Let us look at it. First thing, they're always seeking for intrinsic value, right? So they focus on determining the true value of the business or the company. And they always aim to buy it when they are trading below their intrinsic value. Okay. Now, what they do, they always use ratios such as PE ratios, ROE. These are the often used ratio by all these investors to determine whether the shares is in their undervaluations or overpriced. So seek out for intrinsic value. Now, second thing, okay, margin of safety. Now, who can tell me from which investor that he mentioned a lot of margin of safety in his investment journey or in his strategy? Who is the person that always talk about margin of safety? Can anyone give me the name? I want to know if you know your successful investor well or not. Okay, many people tell me it's Warren Buffett. Okay, Peter Lynch. Okay, right? Great. I got the answer. All right, I got the answer. So Benjamin Graham is the one who actually talk more often of the margin of safety, especially in his book, right? So what is margin of safety? It's actually looking for the assets that have a significant gap between their market price and also the intrinsic value, right? So intrinsic value is what I shared in the previous slides, right? So it is to understand the true value of the company. And the value is not always reflected by the share price. Agree or not? Right. So if let's say there is a gap when the share price is below the intrinsic value, then this is what we call the margin of safety. It's actually a buffer for us to reduce the risk of capital loss. Yeah, and Benjamin Graham believed that a safety buffer is crucial, to protect us against the unforeseen market fluctuations. So when there is a market crisis, you still can be protected by all these downturn. Because of what? Because you are getting a buffer, a safety net, okay, about these underlying assets. Okay. Now, this is the illustration of how margin of safety work, right? But I will not go deep into it. All right. Next, what they do, if let's say they have a value investing mindset, right, they will avoid speculations. Now, speculations and value investing is a contradict investment method, right? For those who speculate at the market, usually, they are not a value investor. Why? Because for value investor, all we look at is the value of the company. We don't speculate the market by the news, by the future performance of the industry. We don't speculate it. All right. So what they do, they avoid speculations and they focus on the company with solid fundamental. And Peter Lynch emphasized the importance of assessing a company fundamentals. Now, this is an illustration how they demonstrate this mindset of value investing in their journey. Now, let me just quote again from Peter Lynch. He said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. It might sound tricky, right? So what he means is that many people or many investors out there, they are trying to speculate the market, but it is the speculation that caused a lot of their losses, throughout the investment journey. So this is one good lesson for us. Don't speculate the market, but we study the company well. We learn to value the stocks, and we buy when there is a margin of safety. And this can protect us against some market downturn. All right. Well, I have no comment on that. Right. Let us move on to point number 3. The number 3 asset mindsets of all the successful investors have in common is continuous learning. Now, growth mindsets and also a long-term commitment, is always very important for investor because they need to be disciplined. And in order for them to remain disciplined for many years, 20 years, 30 years, they need to continuous learning about the new trend in the market and the potential value emerge in which sectors or industry. They need to know. So in order for them to have the in-depth insights about the industry, they need to learn about a lot of things, right? And financial markets is always a dynamic and constant evolving market. So we need to always read, study the market trend, and seek to deepen our understanding of investment strategies. And I believe it is what drives you all today here into the webinar, because you are also wanted to learn how can we improve in our investment. Am I right? Now give yourself a lot of pros because you are giving yourself an opportunity to learn and to improve in your investment journey. Now, and one very important thing when we talk about continuous learning is to not afraid to admit mistakes and learn from them. Now, many people they read books, you know, and they say, I read books, I'm having a growth mindset, you know. But when they have some mistakes in their investment, they're not willing to accept it and to admit the mistakes. Rather on, they will say, no, this is not my fault. This is the fault. This is the market problem. Market is causing my you know, my investment decision wrong. They are not willing to learn from their mistakes. Now, for us to become a successful investor, we need to always learn from our bad experience and turn it into the skills or the good you know, points or the guidance when we are doing investment in future. Right? Just as what Warren Buffett did, right? He is very well known for his voracious reading habits and his commitment to continuous learning. Now, I want to quote this thing from Albert Einstein. Although he is not an investor, but he once said, once you stop learning, you start dying. So everyone, if let's say you want to become active, you know, you don't want to start dying, then you shouldn't stop learning, right? Now, okay, how as an investor, we can demonstrate this mindset or this habit into our investment journey. First thing, extensive reading. Now, everyone, you know, you need to read a lot, you know, because all the successful investors, they read. Some even have their own books. Am I right? Like Benjamin Graham, Peter Lynch, like Ray Dalio, they all are a very voracious reader, and they constantly consume the news, books, reports, and research, you know, to stay informed. Now, when we say to stay informed about the market trend and development, it's not that we actively trade in the market, but we keep ourselves abreast with the update of the market, so that when something happens, you know, macroly or microly about our companies, we know what happened and what we can do, you know, our next steps, what we can do, you know, in order to keep our investment safe. This is very important. Okay, now people say when you read too many share analyst reports, you get too much noise and confused. Okay, what happened? Why you will have this kind of confusion or much noise when you read too many analyst reports? It's because when you are reading it, you don't have your own stance or your solid understanding of the companies. So, for example, there is a stock, for example, Maybank, a Malayan banking Maybank, right? So there are a lot of, you know, analyst report about this bank itself, and different fund manager or different research analysts, they have different view on the company itself, because everyone interpret the data differently. Am I right? So when we are reading the reports, we don't simply, you know, follow what the analysts say. We need to do our due diligence. We need to understand whether the analyst is saying the right one, or they are just merely based on their own understanding and they just write something just to fulfill their work. You know, we need to have our own due diligence and our own thinking. Then you will not get confused by all this noise or the you know, different reports. They will give you different ideas. All right. Now, Warren Buffett estimates that he spent 80% of his time reading and thinking. Now, how many hours you need to read to keep updates on, you know, with all this news every day? For me, I usually take about 30 minutes to 1 hour every morning before the market opening, and always during lunchtime, if I'm not in an appointment, I will actually also read out some news. And there's really good things, you know, because in Malaysia we have the edge markets, right, where we can have updated with all the business news in a market, and also from the overseas international global news. So from there itself alone is actually quite sufficient for us to consume all these informations. Now you just need to spend 30 minutes to 1 hour to read some news, you know, and then you can know about, I think, 60 to 70% of what goes on in the world. This is sufficient enough. All right. Now, second thing, learning from mistakes. As an investor, we need to be open-minded and embrace our mistakes and failure. And we see that as a valuable learning opportunity for us. Because from the mistake itself, we can analyze why are these mistakes happen. Why? There must be something that I did wrongly, or something that I researched that are not correct, causing the mistakes to happen. So we need to analyze the error so that we can prevent it happen next time and identify some learning key points and practices. And let me just quote from Charlie Munger. He once said, forgetting your mistake is a terrible error if you are trying to improve your cognitions. So don't forget your mistake. Embrace it, embrace it and learn from it. Take it as a good learning opportunity. All right. Now, the third thing, they're always seeking for a diverse perspective. Now, where we can get diverse perspective? From the research report, am I right? Or from different market or economic commentators. They have different views, about what's going on in the world. And then we can always listen to their opinions. And we make our own decisions, whether we want to listen to which part of their statements, right? And what we can do, we can always engage in discussion with our peers, our mentors, even with some of the market experts. We can ask for their opinion about the recent market news or the recent activity that might cause some fundamental change in the companies that you already bought in. Just for example, I'll give you an example, right? So let's say you have invested into a banking stocks, right? And then when there is movement in the interest rate, for example, OPR rate is the Bank Negara Malaysia is hiking raising the OPR rate, and you don't know, is this good for my banking stock or not, right? So you ask professionals. Who you can ask? You can ask economists, right? You can ask them, hey, OPR rate is raising. It is good for the banking stock or not? All right. So if let's say you don't have this extensive network of expertise, right? Ask the research analyst. And where can you ask? You can always look at the report, right? And just to give you a tips, when you look at the research report published by all these fund houses, right, or the broker, they will always put the email address of the research analyst. Just browse it and you will see. Most likely they will put in some details, the email, or I don't think they will put in the contact number, but they will put in the email address. So basically, you can raise your question via the email, okay? But whether they will reply you or not is the other story, right? At least you do your best. You ask them and you raise up your questions, right? Now, this is what Charlie Munger speak of his Warren Buffett. Okay, sorry. Okay, Warren Buffett speaking about Charlie Munger. He said, I can see, he can hear. We make a great combinations because both of them have quite diverse investment strategy or mindsets at the beginning of their collaborations. And from there, they learn to, complement each other, and from there, they make a very successful combinations. And until today, Berkshire Hathaway is a very good investment company in the world, right? Now, I have shared about the top 3 mindsets with you all, So the first one is always think for a long term. Second thing is value investing mindset. And the third is to continuous learning, keep yourself abreast with all the updates and the knowledge of the market or of the investment. Now, what I shared just now, right? We all talk about value investing, long-term investing. Why not short-term trading? Why I don't touch on short-term trading? And what is the difference between short-term and long-term? Everyone asks me this question most often, right? So let me just give you some brief differences or introductions between short-term trading and long-term investing, right? So short-term trading, the characteristic that they have and all the short-term trader they have, the mindset or the habits that they have is that they are very used to price fluctuations, because price fluctuations is the opportunity for them to make money or to earn profit. So they are very used to price fluctuations, and this is a very contradictory mindset we have as a value investor. Am I right? Because for us, we try to shy away from all these price fluctuations. But in the eye of a trader, fluctuations is the opportunity for them to make money. So these are quite opposite view in terms of mindset. And second thing, they're always ready to cut loss when when the market or the movement is not going to their ideal directions. For example, they anticipate these stocks to grow within the next 1 week to 2 weeks, but then it goes down and break the support level. So they are willing to cut loss, and they are not holding it for long term, because for them, they are very clear of their end goal when they trade the stocks, is that if let's say the stock break my support level, I need to cut loss no matter what, right? And when the price is hitting their target profit, the target price level, they need to take profit no matter what. So you need to be more disciplined with our investment when you are a short-term trader, right? And let me do a comparison, okay? Let me do a comparison. For a short-term trading, in terms of time perspective, right? Short-term trader, we need a near-term focus. That means we need to be very focused on the market movement closely, right? And they are concerned with capturing quick price movement, right? While for long-term investor, we are actually not that concerned with the short-term price movement, right? Because we are more focused on the long-term potentials. And we are not monitoring the market every day or even every hour. Some even every minute they are staring at the monitor, just want to see and to look at and to monitor the market movement, right? So in terms of time perspective, we can know that short-term trader and long-term investor, we are actually quite different, right? Now, second thing, risk tolerance. Okay, for short-term trader, they often have a higher risk tolerance because they need to expose to the short-term market volatility. The short-term you are, the higher your risk. Okay, in terms of trading. Okay, in terms of trading, because the price move quite often, quite active during the trading hour, and usually they will use leverage just to amplify their position. But over here, I want to suggest to every one of you here, if let's say you are not very confident with your trading skill or your investment skill, better not to use leverage products, in your investment. All right. Now, for short-term trader, they always prepare for a possibility of quick gain and also quick losses. These are very usual for them. But for long-term investor, we are actually quite low risk tolerance. We are quite risk averse, and we always prioritize capital preservations. What our investor always said, the first rule in investment is to, what our investor always say? The first rule in the investment. Anyone know? Okay, the first rule is not to make losses. All right. If you not make losses, you're considered 50% above the average. Now, when you make money, you are better than the 80% of the investor in the market, right? And for long-term investor, we always focus on achieving long-term growth and wealth accumulations, all right, for a long run. So this is a comparison between in the perspective of risk tolerance. And last is the emotional control. For short-term trader, they need to maintain a high level of emotional control, because the price move very fast. If let's say you cannot control your emotion, you just go in the market, I need to make my order right now. Simply based on your emotion. This will not make you a good trader. All right. So you need to control yourself. All right. And for short-term trader, you need to always avoid making impulsive decisions. And everyone, I know you heard of FOMO, right? fear of missing out. And FOMO is a bad thing for a short-term trader, for a successful short-term trader. No. All right. So for a long-term investor like us, we can afford to be more patient because we are less emotionally attached to the market fluctuations, and we are better equipped, to weather the market downturn because of our understanding of the underlying values of the investment that we make. All right. Because of that, we have a better margin of safety compared to the short-term trader. Right. Now, just a brief intro, differences between the short-term trading and the long-term investment. And now we are going into the last part of our sharing today. Okay. Now, over this part, I will guide you to identify your money personality, because I share about long-term investment, value investing, short-term trading. And you might ask, George, am I suitable to use value investing, or am I rather more suitable with short-term trading at this moment? We all don't know, right? I'm not saying that short-term trading is a bad investment skills or strategy. It is still a good one if you know it and if it suits your current situation, or your personality. So next up, I bring you to identify your money personality, and I will let you know what are the better strategy, or the investment method that you can use in your own. All right, sounds good? Can everyone bear with me? Can still keep up with me, or am I going too fast? Okay, just let me know. Okay, I'm gonna drink a sip of water. Okay, just sip of water. All right. Now, everyone is okay, then I'll move on, right? Okay. Now, okay. So this money personality, okay, is actually based on this book from Secret of the Millionaire Mind. Okay. Now, how many of you have read this book before by T. Harv Eker? Now, put in the comment sections and let me know how many of you have read this book before. The Secret of the Millionaire Mind. Okay. Think rich to get rich. Okay. Now we have a few. You have read this book before, and the next thing I think you might already know about it, right? So there are actually 4 money personalities in overall. Okay, in overall there are 4 money personality. Okay, all right. Now I will just do some brief explanation of what each personality is, and let me know if let's say you are falling into the category, right? So the first one is saver. Okay, so as the name said, right, saver is a person who always like to save money. Now this person, if let's say he is earning 5,000 ringgit per month, they can save up to 3,000, 4,000. Any one of you can do this or not? Like, if let's say you are a saver, you are the person who don't like to spend money, you always save money. So you just put in your comment section, let me know you are a saver. I want to see how many of you here today is a saver or a spender or avoider or money monk. I want to see the percentage of it, right? Yeah, someone say I'm stingy. Yes. Oh, many people say you're a saver. Now, there is a one personality that a saver always have, and it might not be a very good one. Is that more people always think that a saver is person very kedekut, a person who are very, when they go out, when they want to buy something or when they want to eat something, right, they will look at the price first. Are you the type of person, who always look at the price first before you order food or you buy your shirts, your clothes, or buy anything? Are you the person? They always think that, oh no, this nasi lemak is 10 ringgit. I can get from the, from the roadside store for 2 ringgit 50 cents. Oh, I'm not gonna eat this nasi lemak. I'm going to save my money. Are you this kind of person or all the saver over here? Are you this kind of person or are you willing to eat plain bread, with maybe peanut butter jam every morning, you know, just to save some money, save some cost, you know. Well, yes, wow, yes, yes, yes. Sometimes, yes, thank you very much. So I can see most of you here are saver, right? So you are more prefer to save money. Okay, good. Now, move on to spender. Okay, now spender are those people, you know, who will spend whatever money they have in their bank accounts or in their wallet, you know. So for example, this youngster earning 3,000 per month, you know, earning 3,000 per month, and he's looking for ways to spend away 3,000 ringgit every month as well, and even more, you know. They like to spend beyond, you know, beyond their income. Now, this is what spender do, because for them, buying, you know, buying things can make them happy, and they're actually not that aware that I need to save money. So for spender, right, if you ask them, hey, you need to save some money for your future, they won't listen to you. For them, they prefer to spend the money, right? And they always have a term, you only live once, YOLO. Now, these are all the YOLO generations. They are more a spender. Okay. Now, some people say if M40 spender is spent in finance, product might gain revenue. Well, I'm not consider you investing in the finance, you know, the stock markets or anything as a spender. So merely means that spender is only for those you're buying, you know, buying unnecessary, non-necessity stuff. You know, you're buying bags, you're buying luxury cars, you're buying, you know, whatever things you're buying, just want to spend all your money. Now, these are all spender. If let's say you are a person, you know, who save your money for investment, then you are not a spender, you are a saver indeed, right? Now, third personality is avoider. Okay, avoider. So, avoider, they have a personalities that they will avoid whatever topic when it comes to finance or money. No, they will shy away. So when you ask them, hey, how much you are making? Are you saving money? Oh, they will shy away. Don't ask me about money. I try to avoid money matters. So these kind of people, right, when they are avoider, right, you will often see that their money will not grow much, you know, because they don't actually care about it, because they wanted to shy away from it. They don't even want to look at how much money they have in their bank's account. And these are avoider. Now, why some people become avoider? You know, why some people become avoider? Because maybe in their, you know, early childhood life, they have some money issue in their family, and that give them a bad, you know, bad image of having money is an evil things, you know. Money is the root of ever. So I cannot have money. Now these are the mindset of avoider, right? And money monk, you know what a monk, right? So money monk is those who are easy go lucky one, right? Like what our friends over here said. So money monk is the one easy go lucky one. They don't care. You give me money, yes, I'm very happy. If let's say you are going to cost me some money, I'm also okay with it. Right? These are the money monk. Now, have you all identified your money personality? Okay. If let's say you already identify what personality you are, put in a yes for me. Put in a yes, and I will show you what type of investment strategy or method that might suit you. Okay. If you already know, put in a yes. Okay. Put in a yes. Okay. Trader will become money monk. Trader, I still consider them as a saver because they also want to save more money for their trading, right? If let's say they are a very successful trader, they don't usually spend on luxury things unless they are very young, you know, and they make a lot of money from their investment or from their trading. Then they might become a spender, right? Now, okay, I can tell many people have already identified your money master, your money personality. Now let us move on, right? So for saver, you always have a low risk tolerance level. Okay, so for you, you are actually more suitable for value investing in the long-term value stocks or a portfolio with a long-term horizon. Why? Because you cannot take high risk, you cannot bear with it. You will become very sad, it will affect you, affect your daily life when your investment is making losses, because it is your hard-earned money and you like to save. You don't like to see the drop in the value of your investment or your bank account. This is what you don't like to see. So for saver, you are very low risk tolerance. So for you, if let's say you want to invest into stock market, go for value investing. Because if you are more confident with the with your research or your analysis on the underlying value of the portfolio or the company, right? It gives you less risk level and you are not that concerned about the short-term price fluctuations, right? So for saver, go for value investing. Okay, you are less likely to get a heart attack lah. Okay, by simply put by that, right? Next, for spender. Okay, so for spender, you are actually quite higher risk tolerance. You are quite high risk. Okay, so what they can do, what spender they can do, because for them, spend money is like drinking water, very easy. They can do it every day. So they are quite high risk one. Okay, so what they can do, they can actually do some value investment in high growth stocks. Okay, high growth. So for example, invest into some technology stock or some some biotech, some new technology or the new trend in the market. Just for example, like AI, some new startup they just got listed, and these are all the high growth stocks might potentially give you a good return, right? So these are what spender they usually go with. Or you can also go for short-term trading, because for them, in the cash inflow and outflow is so used to it. They are so used to it with all the money come in and out, right? So for spender, short-term or short-term trading is actually quite suitable for you. But bear in mind, you need to master the skill, how to do a proper short-term trading. If not, you're still wasting all your money into the stock market, right? For the good people, you're just donating your money into the stock market for nothing, right? So for spender, this is what you can do. Next, for avoider, avoider, they are usually very low risk tolerance, because they try to shy away from all the money matters, right? So investment is a no-no for them. Why I want to make money when I try to avoid money, right? Investment is about making money or growing my capital, growing my assets. Why I want to do so when I'm so trying my whole life, my entire life to avoid money, right? So they are very low risk level. So what they can do, they can actually do value investing in income stocks or income portfolio, because usually when we talk about income stocks, right, they are more stable and they can give you passive income of dividend income. It's about dividend investment, right? So for avoider, once they invest into this portfolio of dividend stocks or income stocks, right, they usually won't look at it anymore. But slowly, it can help them to grow their portfolio as well, right? So for avoider, this is what you can do. Now, moving on to the last personality, the money monk. Okay, the money monk. What is the risk level? Okay, what is the risk level? Like put in the chat room. Okay, make a guess. What is the risk level for money monk? Okay. Okay, some people say high. Okay, some people say money monk have a high risk level. What else? Anyone think that money monk have a very low risk level? Anyone? Okay, now for me, okay, well, some people say moderate. Yes, medium. Okay, for me, money monk, they have an identified risk level. We don't know. We don't know because they are very easy-go-lucky. They are very easy-go-lucky. So when you ask them, hey, invest into stock market, wow, this stock 10 in 1 year surely can go up to 100%. But the potential losses is 200%. You okay or not? They say okay lah. okay, they easy go lucky ma. So they say, okay. So when they ask them, hey, I think we better invest into value stocks. Those can give us stable 10% return per annum. They also say, okay, no problem. Because they don't want, they don't think much about investment. Okay. So any type of investment methods are suitable for money monk, so long that you agree with the concept and the strategy itself. So long that the investment makes sense to you, it is quite suitable for you. Okay, it's also quite suitable for you. So if you are money monk, at this, you can do a lot of things. Okay. Now some people say easy go lucky, like buy 40. No, buy 40 is something like what spender will do. What spender will do, because they are trying to gambling and they want to bet for a higher return. Now this is what spender will do. All right. Now I hope that you have identified your money personality and you know better now what are the investment methods that suit you better. All right. Now let me just come into the summary in conclusions what we have learned today. All right. So the first thing we have learned about the top 3 mindset of a successful or a good investor is to think long term, value investing, and also continuous learning. Right. And the second thing we have learned today is the difference between short-term trading and long-term investing in terms of time perspective, risk tolerance level, and the emotional control involved in the investment strategy. Right. And last but not least, we have learned about the money personality of a saver, a spender, an avoider, and also the money monk. Now, before I end my sessions today here with every one of you, I want to help you refresh with what I have shared today, right? So for the top 3 mindset of a good investor, think long term, what we can do to demonstrate or to practice this mindset of long-term long-term thinking. Give me write down what I've shared just now, right? What the successful investor they will do to illustrate this long-term thinking. Okay, can anyone still remember what I shared just now for a long-term thing? Okay, great. Buy and hold, ignoring short-term noise. That's good. That's good. Very good. Now, how about value investing? Okay, how about value investing? What I have shared just now, what we can do, to practice value investing in our investment. Okay, intrinsic value, yes. What else? Intrinsic value, very important, right? One more that has been mentioned by Benjamin Graham in his book. Yes, great. Margin of safety. Yes, and the PE ratio, ROE, these are the ratios that they always look at, and avoid speculations. Very important. Avoid speculations. And last but not least, continuous learning. How can we grow ourselves through continuous learning? Okay, how can we do that? Reading, yes, reading. What else? And one more very important thing. Not only read, okay, not only read, and one more important thing, okay, for us to continuous learning is to learn from our mistake. Very good. Admit it, embrace it, and learn from it. Right. So these are the 3 mindsets. Bear in mind, and I hope it will help you in growing yourself to become a better investor. And I hope to see you in the next 5 years, 10 years. You can become someone like Warren Buffett or Peter Lynch in your own, for your own investment. All right. Now, with that, thank you everyone for spending your night listening to my sharings. I thank you, and I pass back to Shane.
Thank you so much, George, for doing this very insightful session on top 3 mindset also of a good investor. If you have any questions to ask our speaker today, please write them at the Q&A box. All right. Okay, we have entered into the Q&A session. If any question to ask George, you may write them at the Q&A box. All right.
Shane, I can see there is a question in the comments and in the chat.
Okay, yeah, the question is, can a 1,000 startup fund become millions ringgit?
Wow, this question worth $1 trillion. So if let's say you manage to grow your investment from 1,000 to million, you can buy me a coffee. Just from a kopitiam will do lah, huh? Okay, for this audience. Well, can we do that? Right? We can, right? So now, if let's say you have time, you can go and Google time value of money, and maybe you can calculate from an initial value of 1,000 to a million. Okay, but you need to say how long is the time that you have, to make from 1,000 to millions, right? And second question, I want to ask you, how much you are willing to contribute into your investment portfolio every month, how much you are willing to save from your income, just to contribute it to your investment. We need to always do that, because if you're putting a lump sum and you're expecting the market to continuously generate a better return and for it to grow to a million, is very hard to do it. But what we can do is actually always contribute more into our investment portfolio. By doing it, it can multiply our investment capital growth in the long run, right? So for 1,000 to 1 million, 2 million, 10 millions is possible. But how well you are willing to do it is like into your commitment, to your successful of your finance.
All right, thank you so much, George. The next question is by Edmund. Where do we find and how do we calculate intrinsic value of a company?
Okay, good question from Edmund. Very good. I think a very good question is because intrinsic value calculations, there are a few, in the investment industry. For example, the most commonly used is the discounted cash flow model, or some people, if let's say you're not from the finance background, you will use PE ratios, PE growth ratios to determine the intrinsic value. But this is my experience, in the past, right? Different industry, they actually have different calculations, in terms of how we can identify the intrinsic value. For example, just to give you some example, for a construction industry or property developers, development companies, right? And all these companies, they are much capital intensive, right? So for capital intensive company, what are the most sought after ratios that we use to value them? People will use price to book value, right? Because they have a lot of tangible assets in their balance sheets. But if let's say we are comparing to some companies that are less cash intensive, right? If let's say you're using price to book value ratios to determine whether they are undervalued or overvalued, then you often find them overpriced, because they have little book value, tangible value or tangible assets in their balance sheet. Then from there, you cannot use the same method to value them. So to answer your question, right, we need to know what are the formula or the valuation method suit for different industry. So how can we do that, right? To give you a more easy way to find out, always read the research report. From the research analyst, you know what are the methods that they use to determine the valuation of the certain company in the industry. So for example, if let's say we are valuing a conglomerate, so they have different type of business segments in their portfolio, So under this part, you can often see in the research report, the valuation that most of the research analysts, right, or the fund manager, they will use is sum of part valuation. Okay, so these are the ways that they often use. So easy for you to go and look at the research report, find out what the professional are using, and then you use the same method, and you come back, you do your own research and the analysis, and you try to find, is the intrinsic value that you find using the same formula similar to what the research analyst calculated. Then from there you will learn. All right, I hope I answer your question, Edmund.
All right, thank you so much, George. The next question by Zhu Ho. do you have any suggestions on how do we learn to read the company to invest? How do we identify good company to invest?
Wow, this is another trillion dollar question. Well, for us to actually find where is the good companies, right? The first thing, it depends whether there are two methods, right? So one is bottom up, from the bottom to the top, and the second is the top bottom method. So top bottom means that we look at the macro, what are the trend in the macro economy, and then from there we identify some of the industry, okay, and then we will actually go and find the leaders in the market, in the industry. So once you have identified about 3 to 5 market leaders in the industry, right, then from there we study their finances, their past performance, if possible study for 10 years, because in between there will be some one-off event happen, and it might cause the ratio to spike up or to drop drastically in that period of time. So we need to look at 10 years performance history, and from there we've also calculate their finances ratios and use the valuation to value whether they are undervalued at the moment. Okay, these are the top bottom method. Now from
Top
bottom
down, you
up,
mean?
okay,
Top
bottom
down.
down, yes, sorry,
Top down.
top down, yes. You see, good. Top down and bottom up. Thank you very much, Shen. So for bottom up, right, we do opposite way. So we study the company one by one. So depends which way you wanted to do. All right.
All right. I think bottom up is mainly used in value investing. Top down is mainly used in growth investing. That's where you can get
Correct.
stocks that in high growth area. Right. I think for some of you who ask question, right, can you please write your question in full sentences and write in the Q&A box? Because if you write in a broken sentence, we can't understand what you're trying to ask. All right. So write them in full sentences so we can understand correctly. All right. So Josh, if I'm a beginner in the market, which strategy would you recommend me to use?
Okay. If let's say you're asking me the bottom up or the top down.
Yeah.
Okay. So if let's say you are a beginner in the market, right, I often will tell the beginner to actually go for top down, because we need to always have the sensitivity. We need to develop the sensitivity of the market or the economy. So by using top down, right, we can actually learn to study the economic trend, happening all around the world, and the economy effect when some certain things happen. So top down will be a very good method, and it can help us to actually avoid the time consumed. When we use bottom up, right, we always look for companies, and then after we spend our time study, and then we find it, oh, this is not a company that is valuable for me to invest in. So it might cost you some time. So top down is a better one for a beginner. But let's say if you are a seasoned investor, right, then bottom up is good, because for you are very well known to all these market trend, market current happening, right? Then you can use bottom up because you are looking for value stocks. Yeah. So for beginner, yes, you use top down. My suggestions.
All right, understand that. George, thanks for your advice. George, just now you talk about, as a informed investor, we must read extensively, right? Continuous learning is what you emphasize. So do you have any good materials or good books that you can recommend to us to read about investing?
Well, if let's say you're asking me, you can always go to bookstore and look for books that are related to value investing. When they mention the name Warren Buffett, whatever books, you can always buy it, because for you need to know what is the investment strategy and the experience that Warren Buffett have, right? So book related to Warren Buffett, you can buy it and to study it. And also, if let's say you are quite well with all these finance term, you can actually go with the book from Benjamin Graham, yeah, the Intelligence Investor. But it is quite a heavy book for you to digest lah. It is for me, for me, I also consider it as a very hard to digest for this book. So if let's say you wanted to sleep at night because you are having insomnia, then you can buy the Intelligence Investor lah. Then I think it will help you to sleep better. But joke aside, these books are good books for you to read lah, for beginner. And then other than that, you can actually go and buy some books. They are more focusing on certain industry. So for example, if let's say you are more interested to property markets, right, you can always go and buy books related to real estate investing or REITs, so that you can know more about the industry or how the mechanism works, so you can go and study the outlook of the market in Malaysia or even internationally. Yeah.
All right. Thank you so much, George. There's comment from all the attendees who say that some companies, they offer good dividends, but however the share price keep dropping over the past 20 years. So what is your view in these kind of companies?
Okay, thank you this audience for asking this question. I think I have shared about this I think in the previous few webinar when I mentioned about value investing and the value trap, right? So by your question itself, right, I can say that you are actually going into the value trap, because for value investing, we often look at the value of the company, right? We don't merely look at the dividend that they pay. If let's say they are paying you a very good dividend yield, but the fundamental of the company is deteriorating and it is not doing good, and they don't have a very good bright futures, So these companies is just surviving, and they are not growing, or they are not money making. So you are going into the value trap, and I don't consider it as a value investing. So how can you gain money, right? In the long run, you will not gain money because the capital depreciation is going to be way more or higher than the dividend that you earn from the particular stock. So for you to better do is that cut loss law, and then you go and find another good stocks with good fundamental and is undervalued to invest in. All right, avoid value traps is very important in value investing. Yeah.
Yeah, I agree. We also have another comment that says that if every month we invest 1,000 ringgit, and in 1 year we only invest like 12,000, even if it gets 10% capital gain a month, it is also quite slow. So what is your view on this statement?
Well, for me, because we are investing for a long term and for long runs, okay. So if let's say 1 month you can put 1,000 into your investment account, yes, 1 year is only 12K. But for example, if every year you can double the money that they can invest into the stock market, and let's put on very simple calculations lah. By the first year you can contribute 12,000. 12,000. Second year you can put in 24,000, and just calculate for 10 years. Your portfolio, just simply by your contribution into it, right, it can go more than 200,000-300,000. If let's say it's compounding 10% per annum, your portfolio can easily go to nearly about 700,000, but not close to 1 million yet lah. Okay, so by saying so, right, we cannot solely depends on investment return to help us grow our wealth. We need to also find a way to grow our active income or other passive income, for us to be able to contribute more into our investment portfolio, So don't always have this mindset that if let's say I am very good in investment, right, I can quit my job anytime. I will say, keep your job, find ways to always improve yourself in your career, and making good active income when you still can, and save more money and to invest into the stock market. By doing so, you can achieve 1 million easily in 10 years. You know, 1 million portfolio easily in 10 years. Yes.
All right. I actually think that I think the statement he made is 10% a month. 10% a month is an incredible return. Assuming that in 1 year, you will have gotten 120%. That means you double your portfolio every year, right? So it is already a very remarkable return, even though the initial capital is like 12,000. But soon, I think in probably 10 plus years, it will probably grow to a million. Well, I think you just do the math. If you double every year, I think more or less that period, you should be able to double that. So to go to a million. So I think it's a remarkable return. I don't see it as low, but I think that it is an incredible return. All right.
And it's
That's
quite
my view lah.
impossible.
Yeah. Like some, if we're talking about portfolio growth, right? Not single stock growth. A single stock growth, I think some people can get like 100% return in a few months, in half years, but that's single stock growth, right? But talk about portfolio growth, right? Is pretty good for 10% a month, right? It's incredibly
Yes.
good, right?
Yes. But don't
Alright,
think
so if
it's
any
quite
more,
slow lah, because Warren Buffett also take many years to grow his wealth, So don't always try to earn money quick. And yeah, remember the first rule in investment: never lose money.
yeah, I think like George said, right? Think long term.
Correct.
Yeah. So what we have learned from George in this session is number one, we should think long term, and number two, we do value investing. And number three, we have to do continuous learning. So we don't stop at one stage, but we learn for as long as we are still alive, right? So that's what we can summarize from the top 3 mindsets of a good investor from George.
Yes. Thank you.
All right. So let me, looks like no more questions. So let me just take over the screen sharing. Okay. So ladies and gentlemen, you just heard from the co-founder of EECameron, Mr. George Po, who shared with us today about how do we have the top 3 good mindset of a good investor. So I hope that you have learned from George today. So for those of you who haven't checked out Bursa Academy,